This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
I had that Northern Alabama rental near Huntsville that I bought a couple years ago and got that property all set up for a lease option. I got premium rent on it because put down a non-refundable deposit of $15,000 on it. So I'm getting at least $100 to $150 premium on the rent. That's for the first year. The second year, it's going to be $2,200. So first 30 days, if something goes wrong, I'll take care of it. But after that, it's all on her to maintain it.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 2227 and greetings from beautiful Coronado Island, San Diego. I'm here with our client and my good friend, Drew Baker. I've been staying with him for the past few days and I want to report what I did mention on the show before, that home equity is massively increasing. And looking at real estate this weekend in Coronado Island, I can definitely say that's pretty true. It's at a record $35 trillion right now. So we will keep reporting on this, but mortgage debt is very reasonable in comparison with home prices and home equity. And there is just so little distress in the real estate market. It's almost not even worth mentioning it. And we'll go into that a little more in future episodes as we have in the past as well. But one of the things I did want to talk about is Drew and I just had lunch with one of his friends, an SEC attorney, and I thought that was really interesting. We talked about different types of financial crimes and different things that go on, cryptocurrency crimes, Ponzi schemes, all of this amazing stuff that happens in the financial markets. Of course, there will never be any end to financial crimes. They're just always going to be there. But one of the things I teased about is the issue of the good old boys network, right? And how it really isn't right that government officials and SEC officials and, any department of government, these people can get hired away by the companies they regulate. And that was kind of an interesting topic, wasn't it, Drew?
Yeah, well, it seems like every institution has its own agenda.
Yeah.
So even within the own, administration, whatever it is, that agency has its own agenda under the umbrella of a larger agenda. And so, when you have people bouncing in between private and public sector, they use that to their advantage. Yeah. So
of course they do, as they should, right?
And
That's what anybody would do.
That agenda comes down to the individual.
Yeah.
So you have the individual, you have the organization, and you have the government, and they all have their own agendas.
Yeah, no question about it. And this is why you want to be a direct investor. And you mentioned this a couple of times over the weekend when we were talking, how you just don't like, an old friend of ours who's doing syndications, right? You said you didn't like investing in someone else's deal, and you own your own rental properties and your own personal residence, of course, here in Coronado Island. You got 2 houses. It's just interesting. Being a direct investor, you're so much better off because you're not susceptible to these problems of the non-direct investor.
Yeah, the thing I didn't like about the syndication deals when I looked at it is I'm coming to the table with all the money. The realtor basically is saying, hey, buy this place. I have all the control and have no skin in the game. I'm taking my equity, which is leveraged.
Right.
And I'm putting it back in the deal. So instead of me getting my 3%, now I have a 12% stake in the deal. Mm-hmm. And all I did was sell you the place with your money.
Yeah.
And then I have control over when I want to sell it and then make money on the back end.
Yeah.
So what are they making 15% and they did nothing and they're just a realtor?
They're just a
And they're
realtor in some
managing it.
cases,
And
but a lot of times they're finding the deal.
they're finding the deal and they're doing it, but they're also getting all that control with the property management, all the deals that come along with that, all the money, so it just seemed like a bad deal. You know, I mean, some of these syndication deals where you're a partner in it and it's favored nations and the incentives are aligned and it's a small pool. Sometimes I think that stuff can be, but
being a general partner is always the best deal, but it does come with more responsibility too. No question about it. Okay. So anyway, remember everybody, commandment number 3, thou shalt maintain control, be a direct investor. Otherwise you leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Number 2, you might be investing with a fool or an idiot. And number 3, assuming they're honest and competent, they take a huge management fee off the top for managing the deal. So that's important. Keep that in mind. All right, Drew, one of the things you've always done is self-manage your properties. And you've been very generous in contributing to our audience and teaching them how to self-manage. You've spoken on our Empowered Investor Pro Zoom meetings and so forth. And, do you have any comments about that just now?
Jason, I want to thank your mom.
Oh, because she was the extreme self-manager.
She was the OG of self-management, so absolutely. And, the thing is if you take your property that you have in your portfolio, the thing about when you talk about having, align your incentives for buying a place, I think what's nice is, when someone buys a place through your network, they're not married to you.
Right.
They
can
and a
do
lot
what
of
they
these,
want. It's their property.
They have control.
Yeah.
And if anything, you're a resource. You're not the general store where someone's enslaved in it. They can go off the reservation and come back and they can get a property manager that they find, and you're just kind of a network of support. And that's what I found valuable. And so when I looked at the portfolio of looking at the statements that my property management company provided me, you can kind of pick out and kind of get a temperament of what the house is like. Is this house... And you can obviously see how old it is.
You did have property managers in the beginning. I thought you always self-managed. I can't remember now.
Oh, no.
Drew started investing about 14 years ago, I think, right? With us. And you bought in Indianapolis specifically. So you did have property managers at first.
I have had property managers longer than I've self-managed.
Oh, wow.
So it's been a long time.
Okay.
Yeah. So I probably had self-managed for maybe like 6 years. And I had property managers for like 8 or 9 years. And so I started with one property and then graduated to that market and then graduated to my entire portfolio. So it was baby steps. And I think the thing, we had a conversation about Peter Thiel, and one of his big things is like a lot of these decisions that you make, they are reversible. So it's not like you're doing something that you're going to never be able to reverse course from.
Yeah, you're not self-managing forever. Just give it a try, everybody. That's what I want you to do. Just give it a try. Take one property, take your worst property manager, fire them, self-manage that one property.
And I think the thing about self-management that a lot of people have the reservation about is they feel like they were when they were kids and they were afraid to call the store,
right?
Because an adult's going to answer. They have that just novice fear of doing something new. And the thing is, you're the one in control. It's your property. The tenant is
the one calling the store.
That is they're the one calling the store. You're just the new owner, Exactly. And so I think there's sort of that fear of doing it. But again, the tenants appreciate the place more when they have the owner there saying, hey, I have this problem. Can you help me solve it? And sometimes you can say, hey, let's partner up and figure out how to solve it together.
And the tenant will help you. They will be your free manager a lot of times. It's amazing.
And if you're in another market, if you're in another place and they're there, the dynamic is such that they understand, they have sympathy for the fact like, okay, well, I can't expect the landlord to be here at 2 a.m, doing something. There's limitations there. And he's in another time zone. So they're kind of a partner in, hey, you're renting the house. If there's a problem, please let me know, and one thing I think with self-management that I don't like is that I think some owners want to like never get a call and they feel like, they create
mostly it's never a call. It's just an email or a text message. Right.
But like, if I call the landlord, they're going to raise my rent.
Right.
I never connect those two to the tenant. They never feel like, oh, I made this phone call, so this happened.
Right.
That is completely the wrong way to look at it. That's not how I do the management style.
Sure.
I'm like, hey, thank you for letting me know.
Yeah,
Let me take care of this.
Okay. So without going too deep into self-management, because
don't get me started.
We're getting off on a little tangent here. And you've shared a lot of that stuff in the past on prior episodes.
Yeah.
So what I do want to tell people about today is that, we're going to have a client on in a moment. And he was the first person to sign up for our Fire Your Managers course with our special Empowered Investor guide, Scott Poirier. And he bought this course, and we did the course with him, and now he is doing lease options and rent-to-own deals. He wants to convert his entire portfolio to this. It is a fantastic way to go. I think it really is the ultimate hack for your real estate investment portfolio. So I just wanted to bring this up again today. I haven't talked about it in many, many months, but go to fireyourmanagers.com, join us for this course. Our course leader for this, Scott, has agreed to add 2 live sessions to this, 2 live Zoom sessions. I'll be on those, Scott will be on those, and they're really fantastic. You can increase your cash flow, you can build more equity, you can get deposits equivalent to 5 to 7, maybe even 10 times the current security deposit you have. You can delegate a ton of your repairs to the tenant and a ton of your maintenance to the tenant and really make them feel like an owner and treat the property like an owner. It's just a whole better dynamic, whole better relationship. So go to fireyourmanagers.com, check that out, and let's hear from one of our clients who's actually doing this exact plan. Drew, thanks for joining us today. Greetings from Denver, Colorado, more specifically Cherry Creek. I'm here with our great client, Bob Pellegrini. He's been a client for a long time, and he just had a recent new success in real estate that I wanted to discuss. And I thank you so much for coming on to talk about this, Bob. Bob happens to live in Denver, and so I reached out to him, and I said, hey, why don't we get together? So here we are. First of all, let's just give a little history.
Yeah.
How long have you been investing?
Started in 2012 with you.
Okay.
And I'm kind of one of the OGs, original guys.
Right.
with your, we did the Arizona property tour.
Yep. That was our very first property tour ever.
Yeah. And I've been a client ever since. We've been doing business with you a long time, really. And, I really appreciate, all the hard work and education that you've given us over the years.
Thank you. And you've got about a dozen properties now, give or take?
Well, I had a dozen, but I pared it back to 8, because I had a lot of C properties.
Right. And so you upgraded. That's such a typical.
Yeah, right. And I rolled them into
upgrade
new construction.
To A properties and new construction. Start with the cheap properties and go from there. Okay, so the big thing that you did though lately, because we had you on the show to talk about all of your investing stuff before, and I know it's been going great. You had one kind of problem property, but the others were working great. Mm-hmm. We talked about that on prior episodes, but this time I want to talk about something special, and that is rent-to-own deals or lease options.
Yeah.
Bob was literally the first person to sign up for our Fire Your Managers course. So thank you for doing that. Yeah. And he is basically taking his portfolio and turning them into lease options, rent-to-own deals.
Yep.
And this is getting you much better terms, much bigger security deposits by a long shot. Mm-hmm. Tell us about this deal you just did.
So the latest one, it was a new construction deal in North Alabama, Huntsville area that bought through the network and had America's Rental Managers as the company. They put a tenant in it, and it happened to be a Section 8, which was okay. It was actually a pretty good tenant.
Okay.
But
not all Section 8 is bad. Some people make that their whole business model and love Section 8. That's all they do.
A little bit of a roll of the dice sometimes. You never know.
I get it.
But after 2 years, I decided I want to get away from that. And when we took that course, the whole idea is to get rid of your management company.
Right. So you fire your manager and you turn your tenant into a would-be owner, and you get a much higher security deposit from them. You get better rent from them. You just get a whole better experience. And you basically wash your hands of almost all maintenance responsibilities as well. So originally you put a tenant in there for 2 years. You had them. Did that tenant leave and you got a new tenant to do the rent-to-own deal, the lease option?
Well, I didn't.
The same tenant?
No, since she was getting 90% of her subsidy to pay for the rent,
Okay.
so she couldn't afford the house anyway.
Okay. All right. So you got a new tenant.
Got a new one in there. Yeah.
Okay. So the question is, though, did you look for that new tenant as a rent-to-own lease option tenant? Is that
Yes.
the way they came in? Okay. Because
Yes.
you could do it. You could just do a typical rental ad and say,
Right.
hey, we've got a property for rent, and then bring up the conversation about
Right.
rent-to-own, or even put them in as a normal renter and then turn them in, a year later to a lease-to-own. So you can do this with existing tenants or with new tenants. That's my point. Yeah.
Right.
Go
Yeah.
ahead.
And you can. But when you're starting off, this is a different technique because you're screening differently here. Because when you have somebody that if it's just a straight up rental, you're looking for a pretty good credit score, a good background, and somebody who can afford it, basically. Right. So if that's all they're going to do, great. Then your search is over with. But when you're doing a rent to own, you're looking for a particular client. So not only that you want to make sure they can afford the rent, but you want to see what's your credit score. If they can't go to a bank and apply for a standard mortgage loan.
Yeah. And usually they can't at first.
Right.
That's the point. They're on a program to basically rehabilitate their credit. And that's going to take them a couple of years, right? And that's why the lease option is good for them.
Yeah. And that's the person you're looking for. You're not looking for somebody with a 700 credit score. Because they can go afford a house,
And a lot of landlords would say you're not looking for that as a traditional renter either, because they're just going to move and buy a house.
Right.
You want someone that's going to be more likely to be a tenant.
Yeah. So the screening takes a little more work. It takes a little more diligence and time. And there's ways that you can make that a lot easier.
Yeah.
That's what Scott Poirier, was teaching us, that, how to screen it.
He's our empowered investor guide that we partnered with to do this program. Yeah.
But when you do that, it takes a little more time. You got to be a little more patient. But when you find the right person, because all it takes is one.
Yeah, right.
And once you find that person, you're able to get them in there because you can get a little more premium on the rent.
So tell us about the deal. Okay. How much you pay for the property?
Okay. Well, I bought it for $3,099.
Okay. So $3,099. And this is now a 2-year-old house, right?
Yeah.
Okay. $3,099 you paid for it.
Mm-hmm.
And what was the lease option or rent-to-own price that you offered it to the tenant for? What did you agree to?
So
the tenant owner, I should say.
For the first year, it's going to be $339,900.
Okay. So they'd buy it for $339,900 if they exercise the option in 1 year.
Yeah, at the end of the first year. Yeah, it's set up to where they have to be in the house for at least the first year.
Okay.
And then they can exercise the option.
Got it. Okay, so they've got to wait a year to do it, right?
Yep.
And what happens if it goes 2 years? Is the price changing?
Yes.
Okay.
Yeah. So if they don't pull the trigger after the first year, then it bumps up to $349,900.
Okay, so it bumps up 10 grand more.
Yeah.
Okay. And how much option consideration or security deposit, in a sense, did you get from them?
Yeah, so the non-refundable security deposit, non-refundable deposit was $15,000.
Right. Okay.
Yeah.
So $15,000, and typically, what's your normal rent on that property? About $2,500.
Well, in this neighborhood, the normal rent is going to be from $2,000 to about maybe $1,950 to $2,100 for this particular neighborhood.
Okay, that's not great by any means for a 309 property, but how much did you rent it to them for on the tenant owner?
$2,100 for the first year.
Okay, and then the second year, it's
$2,200.
Okay, and they've got a $15,000 deposit, and normally you would get about a $2,100 deposit.
Mm-hmm.
So basically, you've taken that deposit and you've now multiplied it times more than 7. Okay, or about 7.
Yeah,
you've got about a 7x higher deposit. And tell us about the agreement on the maintenance responsibilities.
So they are going to be responsible for maintaining the property.
Right.
So the only thing my responsibility is to maintain the insurance on the structure and the property taxes.
Okay.
So, but before she moves in, I make sure everything's 100% ready to go.
Got it.
Yeah.
So you don't have to do any maintenance, and because of this rent-own deal, you're really not managing a property anymore. You've done a deal with someone who is now thinking like an owner,
Right.
is going to maybe become an owner, right? They've got the option to become an owner.
Yeah, exactly.
In 1 year or 2 years.
Right.
Now, does it extend out to 3 years, or is it just 2 years? At the end of 2 years, it's over.
Well, at the end of
They
2
don't
years,
exercise.
we just put a clause in there that if at 2 years we can roll it forward and we renegotiate a new price and,
Right.
and an increase
A
in
totally
rent.
new deal.
Yeah.
New rent, new price, new everything.
Yeah.
And new deposit, new non-refundable deposit, or NROD. As they call
Correct.
it, right?
Yep.
And you have to really add back in the lack of property manager expense now to your deal.
Correct.
Because not only did your rent get higher, but how much were you paying your property manager? About $150, $200?
Yeah, it was about 100. Yeah, it was $152 a month.
Right. And so now your cash flow is really increased by, it's about $350 a month more.
Yeah.
Okay.
Right.
But it's even better than that because, as we all know, and we have taught you so many times, everybody, that your property manager is never the deal you think it is, because they're nickel and diming this, that, and the other thing. That's really good, Bob. What else do you want people to know about it? This is great.
It's not for everybody, but if you have some properties that are, in the more affordable range, because I still have some Memphis properties,
like C-class type property.
Yeah, and there's people that would be interested. This would be a good fit for somebody like that. Works hard, makes pretty good money, but they want to build some equity.
I mean, it really does. We have lots of student examples with people doing this with C-class, B-class, A-class, every strata of property. But of course, it does work a little bit differently. The advertising for it's a little different with each one. It can work with anything. Yeah. Do you want to do this with all your properties now?
I am working my way towards doing that. Yeah, because some of the C-class ones that I still have. So if I sell it, fine. I just roll it into a newer, better property.
Exchange.
Yeah, exactly. So I'd be okay with it if I ended up selling most of them.
Yeah, and many times the tenant doesn't exercise the option, so that $15,000 deposit, unlike a security deposit, you don't have to give it back. That's the option. They are paying you for the right to possibly buy it 1 year or 2 years in the future. And some people do these out 3, 4, 5 years even. It's just a personal preference as to how long you do it. But that money is yours to keep.
Yeah.
So that $15,000 you collect.
Yeah, it's just a great way to simplify your self-management, because now you're putting a lot of the onus on the tenant owner to maintain the property. So it really eliminates a lot of those little stupid things, like clogged drains and
silly stuff. The doorbell doesn't work. I mean, just dumb little stuff, which, by the way, more and more in your contracts, just eliminate these things by contract. All of these little things, your tenant, just get them to be responsible for it. Many times they will, because they're not renting an apartment, they're renting a single family home. And so the attitude, even as a renter, as not a lease option buyer, tenant owner, their mentality should be different on a single family home. And we've taught you about that before. So good stuff. Bob, thank you so much for sharing this with our audience. We appreciate it.
Yeah, thanks.
And always appreciate the long-term business. And you've been on the show a couple times before talking about it. Many people have met Bob at our events on the recent Empowered Investor Cruise that we had. You were there. Yeah. So it's always great to have you. Thanks.
All right. It's my pleasure. Thanks for having me.
The following is a blog post found on jasonhartman.com/blog.
The possibility of buying rehab properties in the area of real estate investment is highly ideal and attractive. Whether you are able or not, you can make an asset out of a distressed property. You are always going to be very tempted by this perspective. Still, the depth problems might be a part of the story. However, this is unfortunately the reality of the situation, and the buyers usually encounter it when trying to find the best rehab project. From both a financial and logistical point of view, facing these barriers means making a lot of choices. In this article, we go into depth exploring the top issues associated with buyers searching for rehab properties and provide the remedies towards them. 1. Financial constraints. Limited budget. One of the most prevalent problems of customers is acquiring enough capital to fund their rehab projects. Having limited financial resources may either lead to property selection restrictions or sacrifices in terms of quality. Financing options. Suitable financing options to buy may become the biggest problem for those who have bad or no credit history at all. Conventional financial institutions can be unwilling to give loans for rehab properties as they are considered to be risky. 2. Property identification. Finding suitable properties. Finding the right rehab property in a desirable location is a task which can be easier said than done. Competition among buyers and limited inventory can make it sometimes difficult to satisfy your criteria of right price, potential, and location. Assessing property condition. Figuring out a correct status of a rehab property is of great importance for setting accurate repairs budgets and profit expectations. On the other hand, it can be hard because houses may have underlying problems that are not visible at first. 3. Regulatory and permit challenges. Navigating regulations. The rehabbing of a given property shall normally follow a very tortuous route through a most intricate maze of regulations and zoning laws. As a result, the intersection between regulation and business is complex, and companies should avoid penalties and costs that result from compliance violations. Obtaining permits. Obtaining the right permits for remodeling can be a bureaucratic hassle for buyers. Permit delays may destabilize project scheduling and raise costs. 4. Construction and renovation risks. Cost overruns. Renovation projects are known for going beyond unplanned costs caused by unforeseen complications or changes in the scope. The buyers are always trying to manage costs and to mitigate the risk of overruns. Contractor reliability. It could be quite challenging to find a contractor who does quality work on time and consistently. Poor assembling or project delays can delay rehab projects and cause potential profit losses. 5. Market volatility and uncertainty. Fluctuating market conditions. The real estate market is by nature cyclic, with changes in demand, supply, and property value appearing now and then. The investors face market instability and adjust to probable changes that can influence their investments. Economic uncertainty. Factors like interest rates, economic indicators, and geopolitical events often make the real estate market volatile. Consumers need to keep up to date and modify their approach as necessary. 6. Exit strategy challenges. Selling at the right price. At the end of the day, the key to a rehab project is to sell the renovated house at a profit. Producing the most accurate selling price will result from an in-depth market analysis and correct timing. Market saturation. In competitive markets, an overhang of rehab properties results in sustained holding times and reduced selling prices. Homebuyers must build brand and implement the best marketing tactics in order to sell their properties fast. Conclusion. On one hand, the search for and the rescue of ill-fated properties can appear to be a tough decision, but on the other hand, it presents splendid opportunities for prudent investors. Through identifying and solving the primary issues that buyers are confronting while searching for rehab properties, investors can unlock an enormous potential to grab the gold in this very dynamic market. By relying on methodical planning, in-depth research, and persistence, it is possible to identify the potential of rehab projects and realize the objectives that were set out when the investment was made.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.